Hello, everyone. Welcome to the July episode of BDO's PE Market Pulse, where we invite a leader in the private equity ecosystem to share their insights on current market activity. I'm your host, Bram Wendy, National Leader of BDO Canada's PE Practice and Assurance, and I have the immense pleasure of having Ali Akbar join us today. Ali is a partner at Ironbridge Equity Partners, a Canadian private equity firm that invests in the manufacturing, distribution, consumer products and services, and business products and services sectors. An accomplished senior leader, Ali has significant experience across private equity, management consulting, and investment banking, having worked in Toronto, London, and New York. He has in-depth industry knowledge within the manufacturing and distribution sectors, a focus of our episode today. Welcome, Ali. Thank you so much for joining us today.
Thanks, Bram. Excited to be here.
Perfect. So, a major driver of the Canadian economy, the manufacturing and distribution industry has been undergoing significant transformation. So, this will definitely be an interesting one. Okay, so to start us off, the last couple of years, high interest rates and higher operating costs have made it challenging for M&A and deal making in the manufacturing and distribution space. As one of the top sectors for investments in Canada, and with market expectation of interest rate stabilization, how do you foresee the remainder of 2024 shaping up for Canadian private equity firms, especially with deals in the manufacturing and distribution sector?
Yeah, of course. That's a great question. And I think something we've all been thinking about in the space. And so, to set the stage, you're absolutely right. I think we've all seen deal activity come down over the last couple of years, particularly from the peaks of 21 and 22. And this is widely held true across all sectors, including manufacturing, including distribution. As I think about going forward, I do suspect we should start to see some recovery in the second half of the year, probably more so towards Q4. And that's off the back of a few key themes. I think, the first piece, starting very high level macro, we should see continued easing of monetary policy. The Feds have made it clear they want to deliver a soft landing. That should hopefully lead to more interest rate relief, which in turn should just drive general stability and economic confidence. And then if I dig one layer below that, at the fund or GP level where I am, there's really two dynamics at play that I think should accelerate deal volume. The first one, you've heard it before. There's tons of dry powder out there. And, I think specifically for funds that have been on the sidelines and waited for the last few years, there's going to be increasing pressure to deploy that capital. And then the second piece I think is more interesting is a number of, there's the number and probably more so the age of the assets within the portfolio for a lot of these funds has gone up significantly. And I think what that means is all of those sponsor-backed exit processes that have kind of been on hold, we'll eventually start to see those unwind as GPs just look to return capital and quite frankly have to generate DPI or liquidity to satisfy their LPs. And then, if I go very macro at the deal level, that kind of ties this all together. And Rob, I must admit, this is anecdotal, so don't hold me to it.
Of course.
But my sense is that, if you think about the bid-ask spread on valuation, that's really, I think that's really been the causation for a lot of the stalemate on deal activity over the last few years. It hasn't gone away, but, I think my general sense is that we're starting to see that narrow somewhat. And, especially with the use of earnouts and other kind of risk-sharing structure to help bridge that gap, which I think will drive more transactions. And so, if you combine all those things together, we should, that should translate to more activity over the next 6, call it 12 months. And then, particularly for spaces like manufacturing where input cost volatility and labor markets have, largely returned to more of a steady state or, within a normative band. So that should be positive for those sectors as well.
No, that's fantastic, Ali. You touched on a couple very key pieces. You talked about the dry powder. You talked about the bid-ask spread. So we see, of course, in the Canadian PE market, but across the globe, there's a lot of investments coming from PE firms within Canada, including a significant number of U.S. funds entering the Canadian market. So with that backdrop of the bid-ask spread, as well as, how much dry powder there is in the market, how do you find the current competitive landscape for manufacturing and distribution deals in Canada?
Yeah, again, that's a great question and something that I think for Ironbridge is really important to us is, we solely focus on Canadian-based businesses. And so, you're right, Canada is an incredibly attractive market for global private equity. I think it'll continue to be that way. I think particularly for our southern neighbors, it's an attractive spot. If you just simply think about it, we speak the same language, we're close in geographic proximity, and on top of that, we tend to have relatively more favorable valuations. So I think we'll continue to see more and more U.S. funds come up here. And then the landscape for manufacturing distribution is no different. I think it'll continue to be challenging. It'll be harder to get deals done, and it'll be more international firms, trying to come up here to gain access to, well-built Canadian businesses. And so if you step back, what does that mean for Ironbridge? What does that mean for our Canadian peers? I think it comes down to the fact that we just need to find ways to differentiate ourselves. I think home ice advantage and being local, definitely helps. But at the end of the day, none of that really matters if you don't have the right expertise, the right industry experience, and, simply put, you just got to show that you're the best partners and stewards of the business going forward. And that's going to, lead to success in differentiating yourself.
No, you're absolutely right. You talked about productivity and labor. So I'm going to shift gears a little bit and talk about the fact that the Canadian manufacturing and distribution sector has been through that significant change over the past decade, where we're seeing an increased pressure for either digital transformation or, Industry 4.0 investments to mitigate risk and also uncover value. And then you have big data analytics coming into the play and AI conversations happening. So are there any specific areas within either manufacturing or distribution businesses that you foresee having the biggest impact, or any trends and opportunities that specifically pique your interest?
Yeah, for sure. I should caveat for anyone who knows me that I'm by no means like a tech or AI expert. I think my iPhone's about 5 models old. So, I think that probably tells you a lot. If I think about what's exciting and interesting and what may drive a lot of the impact from what I've seen is any of the areas around the AI or machine learning with predictive analytics, I think will be super powerful. Whether it's predictive maintenance, whether it's real-time demand forecasting or automated supply chain, management that's completely synced. I think all of those, are going to have potentially be massive value drivers going forward. And I'm just excited to see how that unfolds. The one thing that's probably worth calling out is, generally speaking, manufacturing is relatively slow on the adoption curve for new technologies. And you've kind of seen that through history. I think where I play in the lower middle market, that's especially true. And so, yes, while I think a lot of these technologies will be massive unlocks for value in the future, I just think a lot of Canadian owner-operator businesses are just not fully there yet. And I don't want the audience to lose sight of the fact that there's just so much opportunity in making sure you just get the fundamental operations right. Do we have the right production flow? Do we have the right process design? What data do we actually collect today? What data do we really need to drive decisions? Those are all first principle questions. And I think at the end of the day, I just look at it, you have to learn to walk before you can run. And I view these emerging technologies as no different.
No, that's fantastic. There's a lot of buzz around these terms as well. And that point about having your building blocks there, that should really, really speak true to a lot of our businesses here. So let's bring it back to Ironbridge. Ironbridge focuses on Canadian companies with EBITDA ranging from 5 to 20 million. What are some of the key attributes that Ironbridge looks for, or you look for, when investing in manufacturing or distribution companies outside of the traditional quantitative metrics?
Yeah, that's a fantastic question. I think, there's no secret sauce here, to be perfectly honest. I think, ourselves and a lot of our peers all kind of look for the same things. I think, from my experience and what's worked for us in the past, for manufacturing, the key attributes are, do we have a business that has real, tangible performance improvement opportunities? Are there still levers we can pull to drive manufacturing efficiencies, to drive costs down? Is there potential for basic robotic automation? Can we deploy high return on capital investments to drive output, and so forth? And so for us, we look at what are the real areas that we can add value, just given our expertise and experience in the space. And I think that's something we look for in manufacturing companies. As I shift to distribution, one of the things I like to look at, and it's a bit more academic, is what does the shape of the value chain look like? And when I say what does the shape look like, if you imagine you have suppliers at the top, distributors in the middle, and then your customers or end users at the bottom, ideally you want to have a shape that is, somewhat looks like an hourglass. You have a massive variety of suppliers up top, you have a few distributors in the middle, and then you have a very fragmented customer base at the bottom. And so, just a gut check is the closer you're resembling that type of shape, the stronger the distributor value prop tends to be. And so that usually leads to more, sustainable returns in the long term and a defensible distribution position.
That's awesome. So would you like to share an example with our viewers of how you partner with a manufacturing or a distribution business?
That's a tough one just because there's no one size fits all. And so, I think every business we've worked with, every management team we've worked with, they all kind of have their own needs. And there's different ways that I think we can be good partners and add value. One example I think of is our access door manufacturing business. We've seen strong industry growth. There's been tons of demand, and our focus has really been, through our whole period, helping management think about, let's think about capacity and what does the future volume demand look like, and how are we ready to execute and satisfy that demand. And so we've spent a lot of time thinking about what the right paths are, which eventually led to us. It was a heavy lift at the beginning, but has now been very successful, where we just decided, let's find a new facility and do a full plant relocation and invest in some really high efficiency equipment. And so that's been a big success for us. And that's been really just about driving growth and volume. You take that example, on the other end, I have, a paintball manufacturing business that has a, much more, call it stable or flat demand profile. And so our focus on that business and how we've worked with management is really like driving manufacturing efficiencies, optimizing our cost bar, whether that's through process redesign, we're implementing some basic, robotic automation with arms for packaging, and, modifying our production scheduling, which is, more nuts and bolts, but those are the things we're looking to do to drive, the 100 or 200 basis points of margin. So, there's not one playbook, but hopefully that gives you a sense of just the goalposts we work with.
No, that's amazing for our listeners to hear about that, because it not only speaks to the legacy, but also the strategic expertise that Iron Bridge brings with